Well, these days, Canadians are feeling pretty stretched when it comes to their pocketbooks. That's one of the takeaways from the latest Bloomberg Nanos poll, that Canadians are feeling more negative about their financial situation. Now, when you go within the numbers, you've got about 3 in 10 blaming government spending for playing a role in that, another 22% blaming businesses, roughly 10%, meanwhile, blaming the Bank of Canada for the financially stretched feeling that some Canadians are dealing with right now. Let's bring in Nick Nanos, founder and chief data scientist at Nanos Research, for a little bit more on the numbers. Nick, when you do these polls, how do you reach these conclusions? What are the kinds of questions that you ask Canadians?
Well, what we do is we unpack different possible sources of inflationary pressure, prices going up, and then we ask Canadians to point the finger, so to speak. The interesting thing, John, in the survey that we did, before, when we did it, people blamed supply chain and pandemic as things that were contributing to the rising cost of living and increased pricing. Fast forward now they're more likely to be looking at government as an inflationary cause, the Bank of Canada, and also companies raising prices. So what we're seeing is a bit of a shift in the last while.
And so, generally speaking, are you getting any feedback on how this is going to impact future financial decisions by Canadians? I think everybody's trying to figure out whether we're headed towards a recession, whether we're already in a recession, and certainly spending by Canadians matters when it comes to that.
Absolutely. We have to worry about these negative perceptions turning into reality when it comes to fewer or canceled or postponed purchasing decisions. John, every week, one of the questions that we ask, and this is critical, about people's personal finances, whether it's better, the worse off, or the same as it was a year ago. 15%, 1/5, say that their personal finances are better off now than they were 12 months ago. This compared to about 45% or thereabouts who say that it's worse off. So people are 3 times more likely to say that their personal finances are worse off than better off compared to a year ago. And this has to be a wet blanket when it comes to what consumers will probably be doing when it comes to spending money, at least in the last part of 2023.
One of the considerations for spending, even if your sentiment is sour, is whether you've got a job. And I think that's one of the things that we've been watching very closely is the employment picture. And generally speaking, you've heard a story about resilient jobs markets on both sides of the border, quite frankly. But when people try to figure out what their employment picture is going to look like, say, going out into next year, were there any key takeaways there?
Well, the thing is that when we look at the forward view on where people think things are going to be in about 6 months, it's actually tepid and flat. It's not positive or negative. It's almost neutral on the Bloomberg Nanos consumer confidence tracking. But the thing is that the employment numbers are not enough. It's how much people get paid. Like, who cares whether you have a job or not if you still can't make a living wage and pay for the rent of the mortgage or groceries? And this is where, for younger people who are more likely to make less, who are entering the job market, the reality for them is probably the pace of increases in income and what they get paid is probably not at the right rate for them to keep up with the rising cost of groceries and the rising cost of rent.
And you mentioned there was finger pointing, or the polling data finding there's finger pointing in a few different directions. Is it commonplace to see people, when they're financially frustrated, to call out government and business, and in this case, the Bank of Canada, which has been ratcheting up interest rates?
Well, usually we don't see people calling out businesses, but there's been narrative in some sectors, for example, in the food sector, where retailers have been identified or at least targeted as potentially, increasing prices. And the thing is that, when these companies are very profitable, people are wondering, well, they're paying for the cost of the groceries. I think what's a little unusual is government. And I think people don't usually identify the government as an inflationary pressure, but we're coming off the pandemic. We still have big government, and that basically creates pressure on the whole system. And the other thing that we can't underestimate are all the new Canadians that are coming into Canada. This welcoming immigration policy from the Liberals has a material impact on the cost of housing and housing affordability. So even though people aren't experts, they're thinking, okay, well, here's a government policy. We want to bring in more Canadians. Fine. Well, where are they going to live? and people see that the price of rent going up, knowing that there are more and more new Canadians and an increasing number of new Canadians coming into the country.
Hopefully we can figure out that supply imbalance going forward. Nick, appreciate your time as always. Nick Nanos.
Unifor, Canada's largest private sector union, has been making quite a few headlines recently. Today, it picked Ford as the lead company of the Detroit 3 auto workers to negotiate a new contract for 18,000 workers who earlier voted to strike if an agreement could not be reached. Earlier today, grocery chain Metro said it had won an injunction to end the blockade of its Toronto distribution centers by Unifor workers, while the union said picketing by striking workers would continue. And over the weekend, union workers ended a long strike at Windsor Salt after ratifying a new contract, including wage hikes and other benefits. A year after being elected, Unifor's president, Lana Payne, has said this year is the time for Canadian workers to win some major gains. She joins us now for more on all that's happening, because there really is a lot. Lana, you came into this job, and it has been a really busy year, and really a really busy recent few months as well.
Yes.
Today, this decision to choose Ford as the lead automaker that you're going to enter into negotiations with. Why Ford? Can you tell us a bit?
Absolutely. And what I would start with is what a time to be fighting for workers right now. It's an incredible moment, I believe, and we're trying to seize it everywhere. Ford Motor Company, clearly I had stated a couple of weeks ago when we opened bargaining that we were leaning towards Ford. That was out of the ordinary to even tip your hand that way. And we've actually selected Ford right now before Labor Day, because we normally don't do this until then. So we're mixing things up. We have a special kind of strategy here right now because of the significance of the moment we're in with the EV transition. Ford, because we've been making progress. We made good progress with them in the last week at the bargaining table. Some progress, obviously, with the other automakers as well. And then, you know, they have been very clear with us as well about their plans for Canada, the timelines for the EV transition, what's going to occur. So this was a very good foundation for us to work from.
What is it that the auto workers here in Canada want you to achieve in these talks?
Absolutely. We have 4 key priorities. Pensions is number 1. Our members have not seen, a pension improvement since 2007, so just prior to the great financial crisis of 2008, 2009. So we have some ground to make up there. Wages, critically important, as they are at every bargaining table right now, given the state of, the cost of living, but also this whole issue of what happens in the transition. How are the plants being retooled? What will the jobs look like of the future? How do we make sure that we protect our members during that retooling process and that they have good income security? And then fourth, making sure we're attracting even more investment to the auto sector in Canada and to our footprint.
What's the concern there with the transition to electric vehicles and the electrification? What would you be worried? What would the workers be worried about losing out on in particular?
Yeah, so making sure obviously that we have the shortest retooling period possible, so they're not out of work for too long, and then making sure that the income security provisions of the collective agreement are improved for that transition period. Obviously, training, all of those sorts of things, and then just having a better idea of what the future looks like in terms of the products that they'll be building. Canadians make great cars, great vehicles here, so I know that they will do well in the transition too. And of course, as we've been saying to all of the automakers, this transition does not work without our members. They're the ones with the skills and the determination and the commitment to do this. And so they need us to make this successful. And there's billions and billions and billions of dollars riding on this transition. So our members are geared up to be able to make it successful.
Where do you think you might get the most pushback from the automakers?
Well, what I would say is that none of these rounds of bargaining with automakers are easy.
Yeah.
And this time we have a number of challenges. The UAW is bargaining, obviously, in the United States, same time as us. This is not a normal situation either. We clearly have these 4 priorities, and right now Ford has, basically said we're willing to sit down and talk about these priorities with you. And so that's a good place for us to be, but we're taking nothing for granted here. Our members' expectations are high. high, and we've been very clear with the automakers that they are high, and those things need to be delivered on.
Let's shift to the metro workers. They've been striking for quite some time now.
Almost 5 weeks, yeah.
5 weeks, okay. So what is the, negotiation sort of environment like right now with that one in particular? Because, I mean, these workers feeling the need to go to these warehouses and try to stop, the traffic into the warehouses.
Yes.
Now they're not going to be able to do that. Still going to be on the picket lines, though. Has something come up? Are they feeling like they're not being heard by the grocer? What's the deal there?
Yeah, so we are allowed to picket there. So
Yep.
the judge basically confirmed that we have a right to picket at all of the employers' premises. This is a legal right that unions have in a legal dispute. What the judge did say is that there are conditions or protocols around that. We returned to the bargaining table this afternoon, and as a sign of goodwill, we are now only picketing at the moment at the 27 stores that are under this collective agreement. Hopefully things will go well. We've seen some movement from the company. Whether it'll be enough, time will tell.
There's many employers that are still dealing with, the impacts of, higher costs on their end, supply chain issues. Grocers are one of them, the automakers as well, dealing with all of these things that, bubbled up during the pandemic, dealing with those costs. Then also, feeling the pressure from workers, as, your union and others are putting on these companies. How do you expect these companies to sort of navigate that, to be able to deal with both of those pressures at the same time in a way that works out for workers?
Well, what I would say is that in particular for grocery store companies, they've been doing very well through the pandemic and post-pandemic. Their profits have increased every quarter. There's no doubt about it. Their CEOs have been rewarded well, and their dividends are doing very well. I mean, if you look at Metro this year alone, they're planning on buying back shares to the tune of over $400 million. So this is, they have plans, they have money, and what we're saying is we have members who also have needs. They have to live in this very expensive city, and it is very challenging to do it at the best of times, but you put in the environment we're in right now, housing skyrocketing, interest rates making everything more expensive, and, these workers slaved their guts out for these companies during the pandemic, and they need to be rewarded for that. Just
quickly, Lana, when you're thinking about the employment landscape in this country, we've seen the unemployment rate tick up a little bit over the past couple of months. The possibility that the job market starts to weaken is out there. That with interest rates rising, that would be a natural sort of progression, the labor market to get a bit weaker. Do you feel a sense of urgency to be acting now before, workers have this sort of advantage, the upper hand, perhaps? I always feel a sense of urgency because you only ever have so much time to get done what you need to get done for working people. And no one in this movement should ever feel that there's a time for complacency, because there isn't. What I would say to you is that I think if you look at our demographics, we are going to have a tighter labor market for a long period of time. And there's a new order to these things right now. And corporations in Canada need to make sure that they are paying workers well and having good quality jobs in order to attract and keep people. Lana, really appreciate you coming in for this conversation today. Thanks so much. Thanks for having me. That was Lana Payne, National President at Unifor.
Good to have you with us. And we are seeing a little bit of buying in the North American equity market after a big day for stocks on Tuesday. The TSX up 80 points right now, or 0.4%. Both the Dow and S&P are higher, despite the fact that we had some fresh storylines around a softer U.S. economy. Let's make sense of it now. Amy Wu Silverman is head of derivative strategy at RBC Capital Markets. Amy, great to see you as always. And we had a guest earlier who suggested that we're kind of at a point where anything that would indicate bad news for the economy leans into the idea of fewer rate hikes, I suppose, or a less hawkish Fed, and investors seem to invite that scenario. How are you piecing together how investors react to the data right now?
It's good to be on with you, John. Yeah, look, we're looking through the mosaic as well. And I always think a key ingredient of deciding kind of where directionally we're going from here is related to positioning. So obviously the rate story has been front and center, but just how invested investors are in certain key names, both, for instance, mega cap tech or the market in general, I think plays a large part. And, when we spoke a few months ago, it was all about FOMO. It was folks who needed to get into the pool, so to speak, for names that had just been rallying, and really just a narrow breadth of names. And I think we're at a different positioning point right now, which is an inflection point to the market in the sense that people are more invested in AI, for instance, or mega cap tech. And so I think the question actually becomes, are there things now to protect that wasn't there at the beginning of this year?
So I guess the other point to build on what you're saying is that after the momentum, particularly for technology, August has been a soft month for stocks overall. The S&P in negative territory to the tune of, I want to say 2%, even after the recent buying. And the NASDAQ 100, which represents a lot of those tech high flyers, is down even more so. So given the fact that you had a lot of upward momentum and then a stall out, that started to influence what you're saying is how people position themselves in the derivatives market?
That's correct. And, if I were to characterize what the option tea leaves are pointing to now, it would essentially be that the upside is fairly limited and the downside is increasing. And, when I look at the numbers that point to that, it's that demand of call options, that implied volatility relative to the demand in put options. So, a few months ago, we were getting signals from the options market that were very reminiscent of what you actually had during the meme craze. So much demand in NVIDIA calls, so much demand in mega cap tech. Not only is that shrinking, you're now seeing bearish sentiment rise. And so essentially, tactically, it's investors saying, we're actually pretty filled up. Are we worried about downside from here?
Now, I want to talk about volumes because we're trying to make sense of everyday moves, and some of our audience members and certainly some of our guests highlight that August can be a sleepier time in the markets. If there has been some positioning for potential downside, does it make a difference the fact that we're now moving into September and presumably that would mean a little bit more action in the markets? I guess I would add into the conversation, you see all this, the pundits note that September is not always the easiest month for the markets.
I think seasonality is a huge factor. And then, you build on top of that in the U.S., we're also entering an election cycle. So I always find this to be an interesting fact, John, but August is typically a month where volatility tends to rise. I think people don't think of it that way because of the summer lull, but it's actually a seasonally rising month for VIX, and then so is September. And the last 2 years, VIX has actually written somewhere around 25 to 40% in September. I do think we're going to see increased volatility. You kind of have people coming back. There are a lot of industry conferences. There are a lot of single name data points as well as macro, and I think those things will drive a lot of the direction from here.
Okay, I want to put some context around Canada versus the U.S. You already talked about all the action we've seen in the tech world. The tech market in Canada as a weighting within the TSX is smaller, even though we've got, big companies like Shopify here in Canada as well, which means a lot more exposure to banks. We just have been getting through bank earnings season, a lot more exposure to commodity-related stocks. Is there anything sector by sector you're seeing and how people are positioned that might inform us of, if people are waiting for some downside, do they see more downside, in the NASDAQ, or do they see potential downside in, a market like Canada?
That's a great question. So, we'll use something like EWC or ITB as a proxy relative to the U.S. indices. And I would tell you right now across the board, when you take all the different sectors and indices and you kind of compare their option price levels, they're all generally pretty low. And the exception where you're actually flagging the most concern remains in the Asian and Chinese ETFs, so your FXIs or your EEMs. One thing I'll say for U.S. and Canada specifically is, as you pointed out, the U.S. tends to be much more of a narrow mega cap tech correlated move. And so if we get a reversion in this growth versus value trade, that could benefit something that is more heavily weighted to something that you traditionally consider value and financials than you would something that's more overly weighted to tech.
All right, really helpful context there. I'm going to keep going and throwing more at you because you always handle it with incredible, astute commentary. I teased to our audience that we'd ask you about oil, which it's kind of been interesting to watch what's happening with crude. It has been finding this ability to stay above 80, although after a nice July of momentum, it has looked a little choppier. You talked about how sometimes in August, VIX action picks up. Bloomberg was saying that at least in the crude market, that market volatility has been at the lowest level since 2020 for U.S. crude futures. I guess for people who are trying to figure out where commodities go from here, you referenced China, which any headline out of China can influence what's happening in oil. Is there anything in particular you're watching in that market?
Yeah, I'll say one thing that's really interesting about energy, which is we had done this study earlier in the year and we continue to refresh it, which is essentially just looking at the Sharpe ratios of different sectors. So, essentially what return premium you're getting for each unit of risk. And what's really interesting is the energy sector continued to remain among the top of all the sectors. And that's related to the upside price targets that you're seeing in consensus. And it's related to the fact that, as you said, the volatility, the per unit of risk is quite low. So, what has happened is, at least in the US, tech has really won out. But I do think back to that growth versus value trade, people are revisiting things, especially as we get event risk ahead, news out of Australia, news out of Europe, that I think continues as we go through year end.
Okay, lots to chew on there. Amy, thanks very much. Great to see you as always. Amy Wu Silverman of RBC Capital Markets on some of the derivative strategy in the markets.
It seems every day there's a new development in AI news. And now, artificial intelligence company Brask is helping celebrities and content creators deep fake themselves with a digital double. This would allow the person to look like they're acting in a commercial or making social content, when in reality, it's a stand-in actor with a celebrity's face and voice artificially placed on top of them. It can even change the language you're speaking and use your own voice. In fact, I'm not even Amber Canbar. I'm Paige Ellis. Bet I had you fooled. For more, let's bring it back to the real Amber.
Did we get you? Maybe other than the outfit change, you detected something else was off, but I have to say it was pretty lifelike. I am the real Amber Canwar now, and this is the real Paige Ellis.
Pinching ourselves.
There you are. That was pretty wild.
Convincing.
It was very convincing.
I sent a take of that to my parents, and they were spooked beyond reason.
Oh my gosh. Well, let's bring in the company that did this. Maria Chimera is the CEO and founder of Brask. Maria, thank you so much. I know it was so much effort to do that, and for all the concern about getting deep faked without your knowledge, this was actually quite a process. I mean, I had to sit and speak for 20 minutes. So did Paige. Is it not actually that easy to pull off a deep fake?
Hi, Amber. Hi. I'm really great to be here with you today. The process is really smoothly. If you want to, as you said, deepfake you just need 20 minutes of short video with your emotions, your identity, and then that's enough for our neural network to replace your appearance and voice. Yeah.
There's a little bit of a taboo around it, concerns about how these images could be used. So it's interesting that you've built sort of an overt business around this, offering this as a service. Tell me about who's using it, who's coming to you to get this done.
Oh, okay, yeah. So we are working with both sides of the market. I mean, not only production companies and studios, but we are also trying to provide our service for talent managers and actors. I mean, not only AAA actors, celebrities, but also we are working with their understudies because, as you know, right now it's impossible to replace charisma of human. Yeah, that's why we need to work with understudies, and this is a win-win story for both sides.
This has been a very contentious issue during the strikes, the actors' strike in particular. There have been concerns raised about how AI will be deployed and potentially harm the actors. So how do you respond to those concerns that have been voiced?
Of course, being the CEO of global AI company, I'm looking for new tech positively. Our team considers a mission to supplement actors, but not to replace them in any way. Brask Doubles is a way for actors to new commercial opportunities. Actors, as I said, in the AAA category can participate in several projects at once. Their stand doubles, thus contribution is necessary for the algorithms to work, get more orders in the same time. For studios and independent production, we are providing the service for optimize their costs. So yeah, this is really great opportunity for the entire market. And we hope that that will be the new norma for the market soon.
Well, but talk about what rules you adhere to. Absent regulation, what are some principles that you govern yourself by to make sure that it's not misused or you don't run afoul of, licensing issues, copyright issues, likeness issues?
I totally agree with you that this technology could be really dangerous for not only the market, but for the users. And I like to think about generative AI based on metaphor of uranium. So at its core, it's just an element. It can give you the pure energy for new ways for making fascinating creative content. And at the same time, it could be the weapon for misunderstanding. So when I said about normalization, I mean that we hope that celebrities and talent managers and the union, the union will help us to normalize this technology. And I think that after we will make this normalization, we will utilize the technology for good reasons. The next step will be regulation, because of course we need to figure out together the rules how we can use this technology for good potential.
And do you, excuse me, do you imprint the clips with sort of a digital signature that would allow people who know how to figure these things out that it's not really me?
I think that labeling is one of the best way how we can recognize that we are contact right now with a generative content. And yes, we can use it, of course. And also, I hope that platforms are big players like Meta or Snapchat or other social media platforms will help us to understand which content was made with the help of Gen AI. This is also very important, not labeling, but recognizing technologies.
I'm curious if you've had conversations with the estates of dead celebrities. If the potential for, an Elizabeth Taylor film to come out brand new, never seen before. And if you have had those conversations, what types of concerns they've brought to you?
Yes, we had these conversations with relatives when we're talking about the right of famous people who passed away. We need to ask their relatives if they are willing to work in such way. And right now we are making really great documentary projects, documentary films, which will include this kind of deep fakes. But I think that this project will be very useful for all of the market, because we will see the great historical figures again in the screen in the new formats. This is really fascinating, can you imagine?
It's a brave new world. Maria, thank you so much for joining us and bringing this to us. It's Maria Chimere. She's the CEO and founder of Brask. And our thanks to Paige Ellis for sticking with me on the desk, not just now, but over the past 10 years. Some sad news. Paige Ellis, this is your last day here.
It is my last day at BNN Bloomberg. Yes, believe it or not, 10 years at this network. In fact, my first interaction with this network was with you at a nearby Krabby Joe's.
Oh my gosh, yes.
We were talking about the potential for me to join and the opportunities here. And I went from a little chase producer to a reporter. It's been an incredible ride.
And so much more. You've gone from a colleague of mine to a great friend, and I'm very grateful for that. And as our viewers know, you've always been a consummate professional. And here's a little reminder of that.
5% of the last 5 trading sessions.
Paige, I'm so sorry. We're just going to work on your mic for a second. Technical issues. We live them every day. It's all good. We're live all the time. This is what we do. And Paige is, by the way, an amazing expert.
Hello, I'm Paige Ellis, and these are... what's his name? The muscle guy. Help me out.
The Rock?
Yes,
Dwayne Johnson?
Paris Air Show.
Are you on your phone? Paige is doing her report,
I was
Amber.
just busted not paying attention. Okay, the teacher
Put the phone away.
Portfolio manager, Aero Capital. I just dropped my mug.
I actually had to do it twice. We retrieved it. There's all sorts of booze breaking now.
And my other question for Paige is, what exactly was in that mug? Thanks and have a good day.
Bring Paige back in. She's that quick.
Oh my goodness, yeah, typical me. Forgot to turn on the microphone.
No, it's all good.
Yeah, key to my trade.
We are going to miss you, Paige. You've done a lot of serious reporting, but you've also brought lightness and levity. And I remember when Frances Hordelski gave me some career advice. She said, be 2 things, be interested and interesting. And you are that. And so we'll miss you deeply.
Oh, I'm going to cry.
I know. Okay, we'll get the tissues. We're going to take a quick break. You can hit her up at Paige Ellis.
Yeah.
And tell her
Paige
all the
S.
things
Ellis.
that you love about her. Maybe she'll change her mind.
Let's check in on shares in Lululemon. That company is raising its full-year revenue forecast. It saw sales jump almost 20% in its latest 3 months. Bulls on the stock hope that it can go on taking business for competitors and defy a slump among many retailers. Our guest has just raised her price target on the stock. We're joined by Abby Zvejnieks, a senior research analyst at Piper Sandler. Abby, thanks very much for giving us the time.
Yeah, good morning. Thanks for having me.
Lululemon, quarter after quarter, what are they doing right that other retailers aren't doing?
I think it comes down to product. Lulu has, put forth innovative, interesting product for a wide variety of consumers, and is really connecting to the consumer in a way that's very differentiated than peers. And so I think that that's really, the crux of why we've seen such strong growth, especially in an environment where the consumer is being more and more selective with where they're spending their money. That consumer is still demanding Lulu's product.
So is it everyone from the youngsters to old people like me who like the stuff?
It is, and I think that the younger generation is very important. I mean, the core consumer when Lulu first started out was, a 25 to 35-year-old woman, and that the breadth of, the addressable market has increased significantly. I mean, men's is now 25% of the business, wow. And these younger consumers are really starting to, adopt some new product that, is different from product from, previous generations. So we've seen a rise in belt bag, in the, Define jacket, in Softstream and Scuba, and these, products are going viral on social media. And you've seen Lulu dig into that a little bit, especially with back to school this year. And I think that that's another thing that's just driving the brand heat around the product and, bringing in a new generation of consumers to the brand.
They're not literally making scuba diving gear, though, are they? It's just a brand.
No, the fabric is called Scuba. It's very soft. You have to try it.
Okay. You said 25% is now men. Now, that's quite an achievement.
Yes, that's right. And I mean, I think you wouldn't have expected maybe, 10 years ago that men would be wearing Lululemon pants into the office. And now, they're continuing to see success with this ABC franchise, and really like defining that category of on the move, which is wearing, technical apparel, for everyday life. And so that's where they've really, been able to really define a whole new market, and tap into that men's demographic as well.
And then 61% growth year over year in China.
Yeah, I mean, that's one that we've been really paying attention to. I mean, I think it's really important to also note that, 2/3 of the stores that they have in China currently have been opened during the pandemic, when there's been obviously a lot of lockdowns that have impacted store traffic. And so we really see an opportunity, as those stores ramp, as brand awareness increases, And, they're only around, $700 million in revenue in China now, but we see, a very large opportunity there.
So the market cap now, I'm guessing north of $50 billion US with today's jump in the stock. No dividend. That's just a thing that Lulu investors don't expect.
Yeah, that's right. I mean, they return capital to shareholders through buyback. So I think this quarter they did about $190 million in share repurchases. And so, that's their method of returning capital to shareholders, as well as investing in the business for, continued growth in the future.
I haven't had time to go through all of their filings today. Did they say anything about theft or shrinkage?
No, they didn't. And that's, one thing I will want to click down with on the company, since we have heard about that from, retailers like Foot Locker and Dick's. But I do think that, there's some categories that are probably more prone to theft that are easier resale markets. And so I believe that apparel is maybe a little bit more insulated, but we'll definitely want to ask the company more about that.
That is interesting. All right. So your price target has now gone to $455 US. And let's have another look at the stock. It's trading at around $391 US. So you do see upside here. I mean, I guess eventually they'll stumble, but you don't see that in the near future.
I don't think so. I mean, I think with the current targets that the company has set out, which are these Power of 3 x2 goals, which includes $12.5 billion in revenue in 2026, I really view that as achievable. And that's what's priced into the stock today. And I think there's upside to those numbers. So that's where I see upside. Our price target's based on around 33 times 2024 EPS.
Abby, thank you very much indeed.
Great. Thank you so much.
Abby Zvenieks is Senior Research Analyst at Piper Sandler.